Let's illustrate the problem. One way to illustrate it is to take a look at what's happened, grouping the American people according to their wealth and income. If you take the period 45 to 81 as opposed to 81 to 14, it's really quite striking. 45 to 81, the bottom 90% of the country was they were getting ahead, 77%. Everybody else was as well. But then you go forward to 81 to 2014, they actually went down in real dollars as opposed to the top 1% that went up 176%. How bad is this problem?
We've had now for decades rising inequality and incomes stagnating or falling at the bottom end. And it's not just the very bottom end, it's half the population at least that's really suffering declines of well-being. And we know that's showing up also in rising suicide rates, rising stress in our society, a lot of unhappiness, falling life expectancy. Can you imagine in the United States of America, life expectancy has declined 2 years in a row. We have the GDP quarterly estimates, but we don't watch what's far more important. Are we surviving? Are we living longer? The answer is no, we're going backward right now. That's a matter of inequality in the country.
And there are studies that track specifically longevity with income and wealth.
Well, we're seeing that the declines are for the bottom half of the population, for those, for example, with high school educations who are really hurting. We know that's a lot of the populism in our politics right now. People don't like the system. It's understandable. They're not getting the right answers yet, but they are saying this isn't working for us.
How does the U.S. stack up versus the rest of the world? I mean, we're looking at the Gini coefficients now for Germany and Ireland, so basically looking at different measures of income inequality. What do you see?
Well, the United States is the most unequal country of any high-income country in the world. And this is taking inequality after you pay the taxes and once you get the government transfers. We are very unequal compared to the countries of Europe, compared to Japan, compared to other high-income countries, our peer group compared to Canada. And that gap has been widening over time. One of the things that's happened is that everywhere, because of market forces, trade, technology, inequality has tended to rise. But it's only in the United States where policy piled on the bottom part of the population, because in other countries they said, oh, well, wait a minute, maybe we should tax the rich more, a little bit different from what we just heard, and make sure that everybody can have health, everybody can have education. But in the United States, and interesting, you picked 1981 as the break point, that's when President Reagan came in, big tax cuts, bashed the unions, and the combination of those two sent us in the other direction, and that's what we're living in now, almost 40 years later.
So it raises the question of what you do about this situation. Francis, I want to bring you in here because it is, of course, Jobs Day. We'll find out what's going on with wage increases, and we can put up a chart that we took from Morgan Stanley that indicates that real wage growth, not just nominal, real wage growth actually is redounding to the benefit of the lower and middle income wage groups.
There's a reason that there are calls for things like modern monetary theory, for more fiscal stimulus that's targeted, and a move away from central banking and monetary policy as the best policy tools. And it's because of these issues that clearly our current policy prescriptions are not effective at targeting. So this is a paradigm shift that even economists and market watchers or day traders probably need to be watching very, very carefully.
So then, Jeffrey, does that mean that the solution, if what made it even worse was policy, is policy the answer to fixing it?
Well, I just want to be careful. Monetary policy, no matter which kind of monetary policy, is not going to fix this problem. This problem is structural. It is how much monopoly power you have in our businesses, how much government help you have for health care or student tuitions and so forth. Monetary policy cannot change that.
But if you combine the two?
Well, I think I just want to qualify that it's not going to be some new trick of printing money or deficits. We don't talk about the fact that all those other high-income countries do actually collect more tax revenues than the United States as a share of national income, and then they guarantee health care, they guarantee higher education. We have a huge group of young people in this country with massive debts on their back because they pay for higher education. They don't finish college, and they end up indebted, without a degree that's going to get them through. And we have a $1.5 trillion of debt on the backs of young people in this country. It's really a shocking thing. Monetary policy cannot fix that. That's budget policy, that's fiscal policy, that's regulatory policy. So I just think we need to keep the categories right on that.
So we come back to taxes. I mean, Ken Griffin, to the contrary notwithstanding, what we just heard from him, taxes. But it's not just a question of taxing, it's what you do with the tax dollars.
That's the key,
by the way. Where do you put those tax dollars? Because I'm not sure all Americans, I think a lot of Americans say, yes, we're willing to pay more taxes if it goes to the right purpose. We're not sure we trust the government to invest in a way that will benefit all of us.
What I would say to any fellow American on this is take a look at other countries. We're often told, oh no, we don't want to look. But look at Canada, look at Germany, very successful, look at Sweden, look at Norway. Just look. I study that for a living, but I'm asking others, go online, take a look. You'll be surprised. Longer life expectancy, more vacation time, no student debt, lower inequality, great prosperity of life, higher life satisfaction. So it's not what we're told by, if I could say, the Wall Street Journal every day, oh, don't do that, you might look like those other countries. Those other countries look quite good. And all I would like people to do is go take a look, go online and examine the US case versus the others and see what we can learn, because there's a lot to learn.
So, Francis, wrapping this into sort of Wall Streeters having this conversation, we mentioned Ray Dalio earlier, and sort of combining more that modern monetary theory, which to some used to be just a crackpot theory, and now major people are starting to talk about it, the relationship between fiscal and monetary policy. Is that inevitable, Francis?
At one point, we're going to have to start taking a very clear look at how ineffective monetary policy has been at not only solving our problems relating to inflation, but wage inequality and even our potential GDP numbers. I would agree that central bank efficiency seems to be much more reduced, and we have to take a shift towards some of these bigger problems that our current policies have not helped. In fact, in some ways, they've probably exacerbated them.
Mr. Dalio is correct that capitalism needs to be fixed, but he's not right that some trick of monetary policy is going to do it. That's another evasion in a way. I don't know if that, I don't want to attribute motives, but that's just another distraction, let me say, from the structural things that we should be looking at. How workers are represented by unions or whether we're bashing unions, that's one. What kind of regulation against monopoly power, what we do with the budgets. Those are structural. Monetary policy cannot solve that no matter what tricks you use. And as a monetary economist for 40 years now, I have been trying to explain there's no magic trick with money that's going to solve problems that normal policy needs to address.